Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Li Auto W latest report. Li Auto Inc. provides a range of businesses and services in the energy vehicle market. The company offers designing and developing premium smart electric vehicles, manufacturing and selling multi-purpose vehicles and sport utility vehicles, sales management and after-sales, services technology development, and corporate management services, manufacturing equipment sales products available through online and offline channels. Li Auto's stock price has significantly dropped by over 30% in the past year due to several key news events and financial reports. The main causes include weaker than expected first quarter profit and outlook, which led to a decline in U.S.-listed shares, disappointing launch of the Li EAT electric SUV, resulting in a 10.34% drop in Hong Kong shares and a 6.2% drop in American Depositary Shares, ADSs. Analyst downgrades from HSBC and China Renaissance, citing concerns about production capacity, competitive landscape, and negative earnings growth. Negative earnings growth, minus 54.4%, and revenue declined nearly 10% over the last 12 months. These factors have contributed to a significant decline in Li Auto's stock price, with some reports indicating a minus 30.36% change over the past year and a fall of over 40% in the past 6 months. The primary drivers of revenue decline in this financial summary are primarily attributed to a significant decrease in vehicle deliveries, resulting in a 37% year-over-year drop. Additionally, total revenues have also seen a substantial decline of 36.2% over the same period. Furthermore, estimated costs related to the recall of Li Mega have likely contributed to the revenue downturn. Net income and profit margins decline. A shift in company performance. The financial performance of the company has undergone significant changes, with net income experiencing a substantial decline. Over the past year, net income decreased by 51.6%, while quarter-over-quarter, it plummeted from RMB 820.5 million to RMB 624.4 million. This downward trend continued into Q3 2025, where net income dropped by 77.8% compared to Q3 2024. Profit margins also suffered a decline across various segments. Vehicle margin decreased from 20.9% to 15.5%, while gross margin fell from 21.5% to 16.3%. The operating margin took the biggest hit, dropping from 8% to minus 4.3%. These declines in profit margins indicate that the company is struggling to maintain its pricing power and efficiency in production. The sharp decline in net income and profit margins suggests a significant shift in the company's performance, which may be attributed to various factors such as increased competition, rising costs, or decreased demand for their products. The company's financial performance indicates a significant issue with its operating cash flow. Despite generating substantial revenue, the company is unable to convert this into positive operating cash flow. In fact, it has been reported that the company used RMB 7.4 billion in operating activities during the third quarter of 2025, resulting in a negative net cash balance. This trend suggests that the company's current financial management strategies are not effective in generating sufficient cash to support its operations. The company's debt level and interest expenses have undergone significant changes in recent periods. Interest expenses have seen a substantial decrease, with a 40.6% drop from September 30, 2024 to June 30, 2025, followed by an additional 34.7% reduction from June 30, 2025 to September 30, 2025. In contrast, the company's debt level has experienced contrasting trends. While short-term borrowings have skyrocketed by a staggering 22.45%, long-term borrowings have decreased by 61.7%. Concerns about inventory buildup and supply chain disruption. The company is facing significant challenges in its supply chain management, which may lead to disruptions and inventory buildup. The presence of supply chain bottlenecks as a headwind in Q3 highlights the severity of this issue, page 6. Furthermore, an increase in net cash used in operating activities due to decreased customer payments and increased inventory purchases suggests difficulties in managing working capital effectively, page 8. These concerns indicate that the company may struggle with efficiently managing its supply chain, potentially leading to stockpiling of unsold products. If left unaddressed, this could have long-term consequences for the business's financial health and overall performance. That concludes the financial summary. For LI Auto W, feel free to comment below, and I will be happy to answer them when possible.